All right, so then let's focus on the Ethereum merge, because that's obviously a very big story. As we said, there's a date, a soft date of September 15th, and that's when the Ethereum mainnet, if you will, is set to merge with the Beacon Chain's proof of stake system. Now, Ron, you have called this the most important event in blockchain history since the mining of the first Bitcoin. And that is quite a bold statement, Ron. Before we unpack that, firstly, in the simplest terms, just explain what this merge actually means.
Okay, so, the way that blockchain blocks are mined is through a mechanism called proof of work. And proof of work effectively means that you need expensive mining machines to validate transactions. And those expensive mining machines have to solve a mathematical problem, which is very, very complex and uses up a whole lot of electricity. And the first computer to solve the mathematical problem gets the reward for mining the block. And that's called proof of work mining, and it's how Bitcoin and Ethereum work. And this is where all the criticism around why Bitcoin and Ethereum use so much power comes out. So you'll remember that Elon Musk and Tesla stopped accepting Bitcoin because they said that they weren't ESG friendly, and that sparked a whole debate around Bitcoin's carbon footprint and how ESG friendly it was. So I stick to my point where I say that this ETH merge is the most important event that's happened in Bitcoin since the first Satoshi block was mined, the Genesis block was mined, and it could be the biggest catalyst for crypto, but it also could be the biggest catastrophe for crypto. There's a much, much, much higher chance that it's going to be a huge catalyst, but there's a very small chance, and you got to manage your risk, that it could be catastrophic. So let's talk about what actually happens. On that date that you mentioned, which is more or less a date between the 12th and the 19th of September, it's actually measured by a block. The old proof of work chain will merge with a new proof of stake chain. Proof of stake is a much more power energy efficient way of validating transactions. It doesn't require all this heavy machinery, and it doesn't use that much electricity. But remember that this is the first time in history that we're merging an existing blockchain, the second biggest blockchain in the world, and the blockchain that is probably the most widely held when you look at all the applications that are built on top of it. And the reason why I say that is, if you take Bitcoin, there are not many applications built on top of Bitcoin. But if you take Ethereum, there are tons of applications built on top of Ethereum, and all of those have users. So why is it the biggest opportunity for crypto? Well, the first thing is, there are probably two cryptocurrencies that institutions can trade today: Bitcoin and Ethereum. Just by mere virtue of size, anything under Bitcoin and Ethereum, Bitcoin has a market cap of $400 billion, Ethereum of, $200 billion. But anything under that is a long way under. It's $50 billion, and it's not liquid, and it's just not big enough to trade. The first asset, which is Bitcoin, is non-ESG friendly and doesn't give you any kind of yield. There's no yield on Bitcoin, natural yield. When this merge happens, a couple of things happen. The first thing is Ethereum becomes ESG friendly. It stops eating up all this electricity, and it becomes ESG friendly. The second thing that happens is that Ethereum now starts generating yield. And when I say starts generating yield, between 5 and 15% yield just for validating transactions. So just for holding Ethereum and delegating them to a staker, you can earn between 5 and 15%. So we move from proof of work to proof of stake. We start earning huge yields, and you've got a ESG friendly asset that could bring huge institutional money into crypto. Imagine an ESG friendly asset that is liquid and is in crypto and is being highly adopted, and now is generating a yield of between 5 and 15%, not through loans, which also have bad debt, etc., but through actual usage on the network. So validation on the network. That is a huge event. There is a flip side to it. The flip side to it, as I said, we've got to manage our risk return, is that there is a probability that the merge won't work. Now, the merge has gone through 3 or 4 test nets, and as of about 4 days ago, it went onto its final test net before the actual merge, and so far everything has gone perfectly and smooth. But we don't know what we don't know, and it is the biggest event that's ever happened. And you're migrating. The analogy that people have used is like flying a Boeing airplane and replacing the engines in mid-flight. And no one's ever done it before. And it's happening now, and there are passengers on board. The plane's full, and there are passengers on board. And now they're changing the engines. And they've tested it 100 times on the ground, but never in mid-flight. And that's what's happening now. And so that brings me to how I think we should play this merge. I think that from a pricing point of view, if you look at what's happened, Ethereum has led this rally, not Bitcoin. Ethereum was trading at $980, and then Ethereum went from, here we go. So you can have a look at it over here. So you've got Ethereum, which was trading at about $980, somewhere around here. And Ethereum is now 111% up since then, or 120% up since then. Ethereum has led this rally, and it's the merge news which has led this rally. And I think that we know that bull markets and runs are kind of like a buy the rumor, sell the news event, or buy the rumor, sell the merge event in this case. And I think that what's going to happen is at some point just before the merge, investors are going to get nervous and say, you know what, we've captured quite a bit of this upside. But now we should probably look at the risk of what happens in 3 or 4 days' time or in a week's time if this merge doesn't work. And that's kind of the strategy which I would adopt trading into this merge. And we can probably speak about that in a bit more detail after Steve's given his opinion.
All right. So you're basically saying, Ron, that this is a huge event, but that it's been priced into the market already. And on the news, you expect a little bit of a sell-off. But big picture, if this does happen, if this is a success, you do concur with Steve that Ethereum has, I believe his words were exponential growth. Is that what you said, Steve?
No, I don't think the growth will be exponential, but I think it'll be rapid and linear.
Okay, so you're in line with Ron's analysis?
I think I disagree.
I'm in line with Ron's analysis on a number of viewpoints, but I want to throw in some side observations.
Assuming I recapped your analysis there correctly, Ron.
Yeah, I mean, the only point I disagree with Steve is I think that Ethereum grows exponentially, and actually at some point in the future may even overtake Bitcoin. But maybe we can have a discussion. Let Steve.
All right, we'll get to the flippening. Go ahead, Steve.
Sure. The semantics between a fast linear and a fast exponential is something that it's like debating on the head of a pin. But just to respond to what Rand said earlier about the caution, protecting myself, I have to put my fists up here in front of the camera to show you how calloused and bruised they are from our last protection. Yeah. You're probably right. I'm trying to protect myself from being too optimistic the next time round. Right.
Once bitten, twice shy, Steve.
That's right. Let me talk about the merge. There is, unfortunately, some misunderstanding about what will result from that merge. As Rand has correctly stated, it takes it from proof of work to proof of stake. As Rand has correctly indicated, this is probably the most, in fact, I read an analysis just recently, the single biggest software engineering project in history, not because of the lines of code, because no software has been tested as thoroughly as this software, because there are hundreds of billions of dollars at stake. Even the moon landing wasn't tested this thoroughly. This has been a work of beauty in testing because so much money is at stake. There is a small chance it fails. I don't think it's going to fail. I think it's going to run like the tests ran, which were successful. But here is the downside. There are massive expectations, and those expectations will be fulfilled by some of the things that Rand mentioned. They will be fulfilled by a tick on the ESG box for institutionals, and they will be fulfilled by the success of this massive engineering project and the confidence in Ethereum to grow with very, very big steps. But what they will not be fulfilled by, because it's not the point of the merge, is that gas fees are unlikely to go down and transaction throughputs will not go down. That happens in 2023 with the next steps in the merge. And there will be a bounce in this price because of the thing that Rand's mentioned, but it will be a much, much bigger bounce when they go to what is called dank sharding, which is the next stage of the merge, which pushes us to TPS and pushes the gas price down. So that's when I would expect there to be really exponential growth.
So in a year's time is when you expect the price to really skyrocket then, Steve?
When dank sharding is implemented, and dank sharding is the one that conquers the two biggest problems with Ethereum. The biggest problem with Ethereum wasn't that it was proof of work. It worked beautifully under proof of work. It was just a perception of too much energy being used, and actually a fact of perhaps too much energy being used, although it reduces every year because of mining efficiency. The big push is for the reduction of gas fees and the increase of transactions per second. That will not be implemented or affected when the merge happens. But what the world will see when this merge happens is that the Ethereum has the development smarts to do all of the stuff according to the roadmap that has been in place for 5 years, leading up to dank sharding next year, and leading up to it becoming the most efficient energy, which would have happened already, the fastest and the lowest gas fees, basically wiping out all the other layer ones out of the market except for Bitcoin, which is a completely different paradigm. So it kicks next year.
I think that we've left out one point, and that is the fact that after the merge, Ethereum becomes deflationary. So remember that Bitcoin is inflationary. Today, Bitcoin is inflationary. It's predictably inflationary, but it is inflationary. After the merge, what happens is Ethereum actually becomes deflationary. So what that means is that the amount of Ethereum that are created is smaller than the amount of Ethereum that are burnt every single day. Because remember, there's a protocol in Ethereum called EIP 1559. And what that protocol says is with every transaction, they burn a certain number of Ethereum out of the market. And so Ethereum actually starts to become deflationary. So now you've got the top two assets. You've got Bitcoin, which is mildly inflationary, and you've got Ethereum, which is number two, which is ESG friendly, generates between 5 and 15% yield, and is actually deflationary. And when you put that all together as an investor, and specifically as an institutional investor, you say to yourself, hold on, look at the brain power behind this, take points 1, 2, and 3, and it could actually be maybe a better investment than Bitcoin. Regarding the sharding and reducing the gas fees and making Ethereum faster, that's exactly right. This is a 5-year plan. But according to Vitalik, who's the founder of Ethereum, he said recently, certainly the hardest and most complicated part of this merge, of the 5-year plan, is the merge. And once the merge is finished, he estimates that they're 55% of the way through the big master plan, which makes Ethereum, as you say, the king of all layer ones. And he alluded to up to 100,000 transactions per second when that happens at virtually no cost. And when he said virtually no cost, between 0.02 cents and 15 cents a transaction. And he's talking about 100,000 transactions, but that's taking into account all the layer twos. So,
Yep. So Ran, I've got to agree with all of that. I did not mention the deflationary aspect, which of course is critically important.
Can we just clarify that for a second before, Steve, you expand on that idea? Because Ron, is that to say that like Bitcoin has a limited supply, we now anticipate there being a number that Ethereum has a limited supply of? I mean, we know there are only 21 million Bitcoin. I get that it's inflationary because more are being mined, but we don't have a definitive number of ETH.
Okay, this is super interesting. So today, actually, there's about 19 million Bitcoin in circulation or somewhere around there. And within 100 years or whatever it is, there'll be 21 million, and there'll never be more than 21 million Bitcoin, right? That's the fundamental of Bitcoin, and that's what Bitcoin is. Ethereum is different. You take the number of Ethereum that there is on the date of the merge, and that is theoretically the maximum number of Ethereum that there'll ever be.
What is that number?
Well, I don't know what it is. We have to look at it on the day of the merge, because after that, what happens is the amount of Ethereum that are released is smaller than the amount of Ethereum that are burnt, which means that over time, eventually the number will tend to zero. Now, when I say over time, it will tend to zero. I'm talking to you over thousands and thousands of years. But unlike Bitcoin, which is going to increase from 19 million to 21 million, Ethereum is going to start decreasing every single day. So more and more and more tokens being taken out of circulation. So that's why this is so powerful, because you're cutting the supply of Ethereum whilst making the network much faster and much easier to adopt. And that's why some people,
couldn't you then just create more Ethereum?
Well, it's not written in the code like that. So remember that these are all governed by code that's written. The same as Bitcoin is governed by code to be limited at 21 million. Right now, as the Ethereum code is written, the Ethereum code doesn't allow for the issue of more Ethereum. In fact, the way the code is written, there are going to be less and less and less and less Ethereum as the usage of the network grows. The more the usage of the network grows, which means the more adoption, the more Ethereum will be burnt. That is the beauty of the Ethereum investment. Not many people understand this. The more the adoption, the less the supply. With Bitcoin, the more the adoption, the supply continues to increase slower. With Ethereum, the more the network is adopted, the more Ethereum are destroyed and the less the supply. Not many people understand that concept.
Steve, we're going to let you weigh in on this.
Yeah, if I can add to that, and I don't actually know the details of 1559 enough to know how that deflationary curve works, but to just say it another way, Bitcoin is non-inflationary because it has a finite cap at 21 million, which is different than saying Ethereum is deflationary, which is correct. But I don't have an understanding of that curve and when that deflation slows down and becomes sort of capped itself. It is absolutely true. I didn't mention about the staking rewards on staking ETH. Absolutely critical. The whole reason why Munger and Buffett and all of these guys are just infuriated by the whole crypto world is they don't produce a yield. And in fact, Ethereum after the merge produces a yield. So it ticks that box. So you've got ESG ticked, you've got yield ticked, you've got deflationary constraint ticked. And most importantly, as Rand pointed out, or as Vitalik pointed out, the merge was the difficult one. The merge was the one they actually started planning for the merge to POS in 2016, and they started really planning in about 2019. A massive project. And if that is successful, the distance that they have to jump from merge to danksharding and all the TPS stuff and all the gas reducing stuff is a much smaller engineering task. So the merge is absolutely critical. And the entire crypto community is going to be watching this on September 14th. People are going to stay up through the night and have parties, and it's going to be lots of fun. And here are my crossed fingers that it worked correctly, because it'll be good for the entire crypto.
So, but Steve, let's go with that analogy that Ron used and that lots of people have been using, and that's trying to change a plane's engine whilst it's in flight. What happens if this does go badly?
No, you see, they were very smart. They said, okay, we're gonna fly this plane. We're going to change the engines in flight, but we're going to do it in a wind tunnel first. And the wind tunnel were the 4 test networks. I think there were 4 or 5. I can't remember. The last one being, I think it's Gorley, it's called, or Goerli, I don't know how to pronounce it, where they were able to move to proof of stake on that one, which is the big one. It hasn't failed once. I heard one of the core developers at Ethereum today, basically on one of the podcasts, just give a big yawn and said, dudes, if we did these 4 test networks, this is a complete no-brainer at this stage. We've done more testing than any other software development project in history. And that's where I sit.
All right. The deadline for this merge has constantly been moved out, though. How do you see the market responding if it doesn't happen between that, September 15th timeframe, more or less? Steve?
It's locked now. It's locked. Yeah, it's locked for, there's a particular block height that it merges in, and that's absolutely locked. In fact, one of the devs today actually calculated the exact minute that would happen. But that deadline won't move in unless there's a bug, and there's no expectation that will happen.
There are no more delays. It's going to happen on that day regardless. But I do want to say that, I'm very optimistic that it will happen. And I think that this is the most tested piece of software in the world, and everything else that we've said. But this is software. And if there is anything that you asked me at the beginning of this interview, whether I think we've seen the bottom. And I think that if there is anything that could bring us to see lower prices than what we saw with all the liquidations, it is a failed merge. I think the probability is tiny. It's there, but it's tiny. And it's the only thing, in my opinion, other than a big black swan event, another COVID or whatever else, that could bring us to lower lows. And if it did happen, it would be catastrophic for the crypto industry. I don't think it will happen, though. I'm very bullish. I'm very long Ethereum going into the merge, a very long Ethereum in my portfolio. But again, we have to highlight the risks, because you got to look at both sides of the coin.
So you're saying the risk is negligible, but if it does happen, catastrophic for the entire entire crypto industry, not just Ethereum. This is going to pull down Bitcoin as well then.
I don't think the risk is negligible. I think the risk is small, but not negligible. And again, I say to you, we've tested ETH and we've moved ETH from proof of work to proof of stake. But remember, there are thousands of applications that live on top of Ethereum. You know, a very common application that lives on top of Ethereum is USDT and USDC, which is US dollars on the blockchain. Now, will those work successfully? And then remember, there are a whole lot of betting apps and financing apps and stuff like that. And will those work successfully? So that's why I said in the beginning of this, I think you should be long going into the merge, because I think the risk return is on your side. But I think at some point, investors are going to turn around and say, okay, we've maximized the return here. And now it's slightly slanted more towards risk of the unknown happening, maybe not even on Ethereum, but actually on a second application. Remember, some of these DeFi applications hold billions and billions and billions of dollars in total value locked in applications. What if something goes wrong? What are the implications? And that's the part that we don't know. And, you know, one thing we do know about software is that despite the testing, when you give it to a user and the user does something stupid that it wasn't really tested for, that's when you realize that, oh, there was a little hole that needs to be solved. So I think there is a risk. I don't think it's negligible, but I do think it's small.
So Ron, then are you selling your ETH leading up to the merger?
I'm never selling my ETH. In my long-term portfolio, certainly I'm accumulating ETH. I've been accumulating ETH right through from the bottom and even now. But in a trading portfolio, if you're just looking for short-term risk return, I think that in a week or two, the risk return profile would be to probably exit ETH and go back into the Bitcoin trade, just because I think that the ETH trade would have run a little bit too much and that there is maybe a little bit more downside than there is upside.
All right. So seeing as both of you agree that if this does work successfully, there are so many advantages, yield, ESG, deflationary. What does this mean for Bitcoin, Steve? Do you see the so-called flippening happening then?
Yeah, I'm not going to predict that one. I think that, you know, there's been predictions of the flippening for about 4 or 5 years as these two dominant coins sort of compete for dollars. If there is a flippening, I don't think it's important. I don't think it's if there would suddenly be a flippening and, you know, Bitcoin is worth 800 billion and ETH gets to 801 billion and then the whole world changes, I don't think that's the case at all. So I'm not particularly interested whether it flippens or not. I think these are the two dominant coins. They both have particular use cases. To remember that Bitcoin has one use case and one use case only. It was the way it was designed. It is designed as a safe harness to carry a token of value called Bitcoin. And on top of that, people have built a wonderful payment system called Lightning, which in and of itself is a marvel and will change the world of Bitcoin. Ethereum was not built with a single use case. It was built with an infinite number of use cases because they put the Solidity programming language on top of it. And so there are two different use cases. It was a fork in the road, and I don't think they are particularly competitive. ETH handles smart contracts. Bitcoin handles the Bitcoin token.
All right. Ron, your thoughts on where we see both Bitcoin and Ethereum in 5 years' time, then, if this all works out as it should?
I mean, I'm going to tend to agree with Steve and say, you know, it's pointless trying to compare the market cap of gold to the market cap of the internet, because it's like, what's the value in comparing the two? If you ask me, I think that the value of the internet is always going to be bigger than the value of gold. I see Bitcoin as the gold, the new digital gold. I see Ethereum as the new internet. So I think at some point Ethereum is going to be more valuable than Bitcoin. But I don't think it has anything to do with the merge, and I don't think it's happening anytime in the next couple of months. So it's one of those discussions that we should kick down the road and say, look, I do think that one day the internet is going to definitely bigger than the new age internet is going to be bigger than the new age gold. And therefore it's quite an obvious thing that Ethereum is going to be bigger than Bitcoin.
Quite an obvious thing. Let's focus on some of the things that could still go wrong here. And you discussed user error. There's also a lot of disgruntled miners that are not so happy that this merge is happening, that proof of work is moving to proof of stake. And they're pledging to institute a hard fork and to continue proof of work validation. Ethereum miner Chandler Guo, one of those leading the charge there. So Ron, what would this hard fork mean? What are the implications there?
So the hard fork is pretty much a given at this point. So let's just quickly talk about what a hard fork is, just to make it simple for the viewers. A hard fork is, right, there is an intention to merge the proof of work chain into a proof of stake chain and to stop the current miners from mining the proof of work chain and to kind of bid them farewell and say, look, you've been great since 2016 or whenever we started mining the first blocks, but now our journey has ended. But what if the miners want to carry on mining the blocks? Well, that's what you call, they have to write a new piece of software and then they carry on mining the blocks. And instead of terminating the proof of work chain at some point, they just carry on mining the blocks. Now, in crypto, that's known as a fork because the road forks. You have a proof of stake chain and you have a proof of work chain. And forks are quite amazing for the holders of the token because what happens is you all of a sudden get two tokens. You kind of get a dividend. So you get, if you're holding an ETH on the date of the fork, you'll get a proof of stake ETH, which is the new ETH, but you'll also get a proof of work ETH, which is the old ETH chain. So now you've got two tokens. And then the question becomes, how valuable is each chain going to be? And if you look at what the derivatives or the futures are telling us, they're telling us that the point of the POS chain, the proof of stake chain, is going to be worth 96.5% of the value. And the proof of work chain is going to be, as you can see on the screen here, 3.5% of the value. So in other words, what they're saying is that 3.5% of the value will stay with the proof of work chain and 96.5% will transfer to the new proof of stake chain. Now, the next question is, well, then who's going to build on the proof of work chain? Because what's the point of having a chain if no one's building applications on it? And there is quite a good answer to this. There are people that believe that proof of work is much more censorship resistant and much more decentralized. This is quite an important point that we have to talk about today. So proof of work is a methodology where the machines answer the maths problem and mine the block, no questions asked, don't really care what's in the block. Proof of stake, the validators, which can be corporates, decide which blocks to validate and which blocks not to validate. And so there is a discussion that says proof of work is much more decentralized and much more secure. And right now, there's no real proof of work smart contract blockchain. But maybe there's a need for one. For applications that require real decentralization and real security, you may need a proof of work chain. Let me give you an example, and maybe I can segue us into the next discussion. But there is a protocol called Tornado Cash where the US has sanctioned a decentralized protocol. We're going to get into it, so I'm not going to dig into that right now. But on Ethereum, if Coinbase or a bank or someone is a proof of stake validator, they could refuse to mine the block because there is a Tornado Cash transaction inside the block. Now, how decentralized is that? How that goes against the principles of blockchain. And that's one example that shows that there actually may be a market for a proof of stake chain. Maybe. From a user point of view, we know that there's a lot of speculation.
You mean a proof of work chain separate?
A proof of work chain separate.
Yeah.
From a holder point of view, from a retail investor point of view, it's going to be fun. And I'll tell you why it becomes fun, because anyone that's holding an Ethereum will get an ETH proof of work and an ETH proof of stake. And these things do crazy things. In 2017 or 2018, when Bitcoin split into two chains, Bitcoin and Bitcoin Cash, both the price of Bitcoin went up. But at one point, the price of Bitcoin Cash went to 40% of the price of Bitcoin. So these forks are always fun. I guess that I don't know whether or not it's going to stand the test of time. The proof of work chain is going to stand the test of time. That depends on whether people actually build on the proof of work chain. But I think either way, it's going to be fun. And either way, anyone holding an Ethereum is going to get that dividend. And there's great upside if it works. And if it doesn't work, well, then your ETH proof of work just becomes worth zero.
Before I move to you, Steven, and talk about the bigger picture here, Ron, just explain to our viewers how exactly one holding Ethereum gets that dividend for validation?
So for the normal investors, if you're holding your Ethereum on a hard wallet, just hold it on the hard wallet. And when the merge happens, when you plug in your hard wallet, you'll have to do a couple of steps to unlock both tokens. If your Ethereum on an exchange, just make sure that the exchange supports both the proof of work and the proof of stake based token. If the exchange says before the merge that they don't support both tokens, my advice is to take your Ethereum out of that exchange and put it into an exchange that actually does support the merge and that actually gives users both tokens. So that's very important, because I remember back in 2017, some exchanges never supported the forks of Bitcoin, which meant that some users never got dividends which were worth 40% at one point of the price of Bitcoin. So very important that you actually check that the exchange that you use, which, by the way, that's the simplest way to do it, deposit your Ethereum into an exchange, make sure that the exchange supports proof of work and proof of stake. Poloniex has said that they will, there's a whole list of exchanges that have said that they will. Just follow those exchanges and just make sure you're on a safe exchange.
All right, Steve, I want to get into that bigger picture issue that Rana touched on, and that's this whole idea and concern that proof of stake could make Ethereum more centralized and give whales an advantage, since they'd be able to stake more crypto that have much more influence at large. What do you make of that? Is that a valid concern, Steve?
It is absolutely a valid concern. So we've seen this concern. What happens with proof of stake basically is the people with the larger stake have the most to lose and have the most voice. But there is a scenario where people have such a large stake that they can overwhelm the validation process. And that figure is somewhere up, I believe, in the high 30% or 40% or somewhere around there. Now, there is a project called Lido. The staking amount that each person is allowed to stake on after the merge, or in fact before the merge, was 32 ETH. Not a lot of people have 32 ETH. So Lido was simply an aggregation system. They said, give us whatever ETH you've got and we'll split it into 32 ETH blocks and we will do the staking. And very, very quickly they hit 32 or 33%. There was a proposal that was, people started getting scared that now the stake that they had caused a danger to the decentralization of the network. Proposal was made by some of the token holders to cap that amount, and it failed. So there is a continuing risk, concern, caution that it is possible through aggregation for one player to have such a large stake that it overwhelms the democracy of the network, the democracy of the validation. That concern has not yet been fully addressed. Lido has started to try and concern it by, carving up their major validators into minor validators and all sorts of things. But it hangs out there like a smelly fish, which is the best I can say. This does not happen in the proof of work world. Okay, there is no overwhelming of a network by a group of miners who have to collaborate, and that's because all the miners are mostly anonymous to each other. There are too many of them. So yes, that is out there. I do expect that there will be some rationality that prevails over there. It is in nobody's interest, including the proof of stake validators, to overwhelm this network. There's too much to lose.
Okay, so a lot to lose at large if this merge fails, and certainly a lot to gain if it is a success, which both of you seem rather confident that it will be. That's going to be a big watershed moment for crypto.